If you're experiencing major FOMO right now because none of the altcoins that you want to buy seem to be pulling back enough to allow you to make a sensible buying decision, well, fear not, my friend, because this is the video for you. In this video, I'm going to show you an indicator that literally anyone can use to know when to buy and sell crypto. And the best part is you don't need to be majorly skilled in order to use it. So whether you're a seasoned trader just not getting the entries that you want, or you're fairly new to crypto and you only know the basics like support, resistance, and how to place a trade on an exchange, you will be able to follow what I'm about to show you in this video to help you make crypto gains in this market. Now, for me personally, I do most of my trading on the OKX exchange because I find it really easy to navigate. I can place orders quickly and it calculates for me how much money I will lose if the trade doesn't go my way before I actually open a position. This saves me from having to manually calculate my risk, which means I can get into trades faster when the right opportunity presents. So if you're looking for somewhere to trade on, check out the link down below for some exclusive bonuses to OKX. Now, the strategy that I'm about to show you can technically be used on any time frame, but for me personally, I like to use it on smaller time frames, especially when the macro, the intermediate, and the micro trends are all aligned. And my reason for this is because the smaller time frame, something like the 15-minute time frame, it helps me snipe the best entries, which ends up giving me a much better risk to reward. One thing to be aware of, however, is that with any strategy that you use for trading, the smaller the time frame, the more accurate you need to be with your entries. So the upside is that trades will present more often, but the downside to that is that false signals also present more often. And that's why you need to have a higher level of skill when trading smaller timeframes. On higher timeframes, you'll get less entry signals, but when you do get them, they're likely to be more accurate, but it also won't have the type of risk to rewards that a small timeframe will have. So you have to weigh up those options. Do you want to be more conservative and have your trades win more often, but maybe they won't be able to squeeze as much profit out of them that the smaller timeframes can have? Or are you happy to have a lower win rate, but the risk to reward on those smaller timeframe trades is that much higher that it well and truly makes up for it? It really is a matter of personal preference, and it comes down to how much time you have to trade and whether or not you can emotionally handle trades not going your way. So it's not really a one size fits all. The answer will definitely be different for everyone. So before we get into this video, I'm going to need you to smash that like button and hit subscribe if you're not already subscribed, and I'm going to take you through some things that you're going to need to set up first. So like I said, I'm going to be showing you this strategy on the 15-minute time frame. And so that means I need to jump to one time frame higher to draw my support and resistance. And the reason that I do this is because I know that whatever time frame I'm trading on, the one time frame higher is going to have a stronger key level. And so I want to use that as my area for entries and also my areas to take profits. So on the 1 hour time frame, I've simply drawn my resistance here because I can see that there is 1, 2, 3 touches to this area here. And on my support, I've drawn it here because 1, 2, and also 3 touches here. So this is the range that I'm interested in for this current strategy. So now that I've done that, I'm ready to add my indicator. Now this indicator that I'm going to show you, it's a free indicator that I personally created, and it's based off a Forex method, which in case you haven't noticed, all of my trading strategies are based off Forex methods. So to add this indicator, you're going to put a direct link to this indicator in the description of this video so that you can just grab it from that link. So once you've clicked on that, you will see it show up here, and this is the ribbon on your chart. Is this not the most prettiest thing that you've ever seen? But don't get overwhelmed. You are going to love this, I promise. So let's talk about what this indicator is and how to use it. This ribbon is made up of a series of fast, medium, and slow moving EMAs. It starts from EMA 2 and runs up to EMA 100. Think of EMAs like a dynamic support and resistance. When you draw support and resistance, like this straight line here and here, it's a static line. The line doesn't move unless you physically move it. But with EMAs, they act as the support and resistance that moves with price. And so we'll often find as price moves away from an EMA, it will be attracted back to it at some point in time. And that's why it's a dynamic support and resistance, because they move with price. This is really helpful helpful for trending strategies because it helps us to know where price is likely to bounce after you have a retracement. So when the price is under the EMAs are acting as a resistance, and when the price is above the EMAs are acting as a support. When you group EMAs together like what you see here, that is what's known as a ribbon, and we can use the ribbons to help us easily identify trends and also the strength in a trend and when it's weakening. Knowing this type of stuff helps you to get your entries, and it also helps you to time your take profit perfectly, which is the most important part because you do not actually make money until you close your trades. In addition to the EMAs being above price, showing a bearish trend, they'll also turn red. So it helps you to identify that it's bearish. When the EMAs are below price, that's a signal of a bullish trend and the EMAs will turn green. You'll also notice that there are two EMAs that are colored yellow. These are going to act as our retest areas, and they're very important EMAs in the ribbon. So here's how this works. We want to be taking our trades on trend changes. So let's say in this example, the current trend is red, meaning it's bearish. We want to wait for that trend to flip and turn green so that we can open a long position. So first thing we're going to do is we're going to wait for price to cross back above all of the EMAs. Once it does that, the EMAs should turn green. Now, just a reminder, my support and resistance was drawn on the 1 hour time frame, but I'm looking for my entry on the 15-minute time frame. So I'm going to press play to wait and see if that price changes back above green. And here it happens. So we can see here that the price just crossed above all of the EMAs, and now the EMAs are starting to turn green. So from this moment on is where I look for my retest of one of the yellow EMAs to get my entry. And I want to be getting that entry as close to the trend change colors as I possibly can, because that's going to give me the best risk to reward. So all I'm looking for now is some sort of retest of one of those yellow EMAs, and the retest can hold as consolidation for a while, or it can just be a bullish candlestick like a bullish engulfing, a hammer, a railroad track, something like that. And so there it is. Right there is my hammer. That was the retest of this yellow EMA. So from here, I can put in my long position once that candle closes, and my stop loss should go below the EMAs. My target would be back at the 1 hour resistance, and this is showing me a 6.6 to 1 risk to reward. Now this right here is the best place to take your entry on a trade, because we want to get them as close to the bands changing color as possible, because the bands will still be squeezed quite tightly together, and that allows me to have a small stop loss. Whereas if I was trying to take entries here where the bands are really wide apart and I have to have my stop loss above here, it's not going to be as good a risk to reward. So now that we're in a trade, this is where the EMAs work their magic. What we want to do is we want to keep an eye on the top 3 EMAs of the ribbon when we're in a long position, and it will be the bottom 3 EMAs when we're in a short position. But once those top 3 EMAs start to fan out away from the other EMAs, this is when you start to get the hint that the trend is extending. And what follows an extension is an exhaustion. And the exhaustion will either lead to consolidation or a pullback. So we use this strategy to identify the exhaustion so that we can take our profits at the peak. Or if you happen to believe that you're in a really strong trending trade, then you can allow for the pullbacks to happen or the consolidation, but you're waiting for price to come back to one of those yellow EMAs. If the price crosses below those EMAs, in the case of a long position, then you want to exit that trade and take your profit while you can. So to do this, we want to watch the top 3 EMAs. Let's play this out. So you can see here how all the EMAs are starting to move up together, and they're on this angle here. That's showing a strong trend. There's nothing to worry about at this point in time. Also, you can see this one here, how it perfectly retested the yellow EMA. It wicked below it, but it didn't actually close below it. So the trade is safe. And see how also our stop loss was very well positioned here because we were below the ribbon. And this here is a good example of the consolidation. So you can see that the EMAs fanned out here, and what followed followed that was the consolidation. This could be an area you would decide to take profit, and if you did, it would still be a 4-to-1 risk to reward, which is a great trade. Or if you thought it was a good trend because the EMAs are still sloping, then as long as price remains above the yellow EMAs, there's not a reason to get out, especially if you haven't hit the higher time frame resistance yet. So I'm going to keep going on this one. Now I have price around the first yellow EMA. So this is where you need to assess. You need to use your skill to decide if it breaks below this yellow EMA and retest it, the trend may change to bearish. So you would want to exit that trade. But if it bounces off the bottom yellow one, it could just be a retracement, in which case you wouldn't worry and you would hold the trade. So far, we don't have a close below the yellow EMA, the first one. And there we go. We've just hit our resistance right there. And this means that the first target on this would have been met. At this point is where you want to either take a profit completely and get out of that trade. It's a great trade. For example, if you risked $100 down here on this trade, you would have made $660. Not bad for a day's work. But if you're one of those people that believes in letting your runners run and you truly believe that there is more in this trade, then this would be the point in time that you would move your stop loss. So you literally go to the exchange, you cancel out your stop loss and you move it to a new price to protect the profit. And the best place to move your stop loss is going to be below the lower yellow EMA where the candles have recently been. So I would move my stop loss somewhere around here. And that means worst case scenario, if I walk away and I'm not watching this trade anymore and it swung around and went the opposite way on me, I've still secured 2.8-to-1 risk to reward worth of profit. In the same example, that would be $288. But see, here's the perfect example. The EMAs, the top three, fanned away from the other EMAs that all stayed bunched together, and what followed was consolidation. Now that we're extending again, we should expect the same thing to happen again. So it's definitely a risk to hold on to this trade for any longer. But for me personally, the way that I would decide this is to zoom back out to the 1 hour time frame now that it's hit my target and decide where the next resistance level is, which in this case, it's not too far away. I would mark both of these levels right here and I would see if I could squeeze that little bit more out of it. Back down to the 15-minute and let's watch this play out. Yeah, oh, there we go. We've hit both of them immediately. But see there again, I had no reason to exit this trade because the price stayed above the yellow EMA, but it was a smart decision to protect the trade anyway. And now that we've found out for a second time, I get to move that stop loss up again or close the trade and take profit because I've now hit my target 1, target 2, and target 3. Let's see what that risk to reward is going to turn out to be at this point in time. We're now looking at a 9.5-to-1 risk to reward, meaning if you risked $100 on this trade, you've now made $959. Not to mention that's a day's work because this trade right here has only taken 20 hours to play out. Now, for me personally, I would take my profit here. I'm not all that greedy. A 9.5-to-1 risk to reward in a one-day trade, that's enough for me, but I'm going to let it play out for the sake of the video and I'm just going to show you where I would close it and take profit if I were to hold on to this beyond hitting my third target. So I'm going to hit play on that and we can see now I'm starting to get a sharper pullback. Haven't crossed this yellow EMA yet, but it looks like it's coming close. And we got a bounce. So fine for now, but we're hitting it a second time. Still another bounce. But again, see another perfect example. The top three EMAs fanned out, that led to exhaustion, and the exhaustion led to consolidation. As long as we're above the yellow EMA, we're fine. We now have a second hit at that resistance area. So again, not below the first yellow EMA, no reason to exit. And here we go, now we've dropped it. So on a retest of that yellow EMA is where I personally would exit this trade if I didn't already exit at my third target. And any of these candles here would be considered the retest of the EMA. So that is exactly how I would manage this trade. Best case scenario, I made $959 off risking 100. Worst case scenario, I'd be out on one of these candles for $716 after risking $100. So the reversal sign is exactly what I would look for here. If I was in a long position, price came down below both yellow EMAs and then came back to retest any of them, that to me would be a signal that it's possible this trend is going to turn around soon. So I would exit this trade. I'm not trying to hold on to it for a long time, remembering that I'm using this strategy strategy because I can't get into higher time frame trades right now because price is not pulling back enough. So I can still make nearly $1,000 a day, even though price is not pulling back for my long-term buys. Now let's look at this for a short position. So using this one here, we can see here that price was in the green zone, broke below, turned red, came back to retest the top yellow EMA in this case. So any of these candles here, you could have opened a short position. Then as we came down, we remained below the bottom yellow EMA, but as price got extended, the outer three EMAs started to move away from the other EMAs. That's your first signal to be careful. We may change trend soon. And then here the price crossed back above the first yellow EMA, retested it, and that there would have been your definite area to exit. So if you had entered a short on any of these ones right here, your stop loss just needs to be above the EMAs and also the wicks of the candles. And then you could hold that down. If you decided to exit on the extension, would have been anywhere in these candles here, a 6.3 to 1 risk to reward, or if you wait for the break and retest back above the EMAs, you would have exited on this candle, a 5.2 to 1 risk to reward trade. But like all strategies, there are rules and there are no trade zones. And if you break the rules or you try to trade in a no trade zone, you are going to increase the amount of times that you actually get stopped out and get your trade wrong. So one thing you need to be aware of with EMAs is that EMAs help you to identify a trend. So when the EMAs are moving up to the right, we're likely to be in a bullish trend. When the EMAs are moving down to the right, we're likely to be in a bearish trend. However, when the EMAs are flat, we're not in a trend. And so this is not a good time to be using this strategy. That is when I would call it a no trade zone. Flat EMAs signify usually consolidation, and consolidation is sideways price action. There is no trend. So when you see the EMAs like this, and they're mostly sideways, see how many false signals you're going to get, especially on a lower time frame. You don't want to be doing that. You definitely want to wait until the EMAs start to slant nicely. This is going to make you much more successful at this strategy. And one of the rules that you must be aware of is that you need to resist the urge to try and pick the trend early. So this would be when you start to see bands change from red to green or green to red, and there's only a couple of them that have changed color so far. If you try to jump in at that point because you want to be in as early as possible, it is likely that you will jump in on many failed signals. And that's just going to increase how often you lose, because the bands can half start to change during consolidations and pullbacks. So you don't want to assume that every time they start to change, it's definitely going to change the trend. So definitely wait for price to break right above all of the EMAs first. If you're looking for a long position, then come back for a retest, or for price to break below all of the red EMAs first before looking for retests for shorts. I hope you gained some value from this video. If this is a method that you are going to try, let me know in the comments down below. And whilst you're down there, don't forget to check out OKX. The links down below give you exclusive bonuses, so be sure to check them out, and I'll see you on the next video.